Stock market investors, welcome back to the channel. My name is Jason. In today's episode, I'm going to give you 3 stocks that I'm buying right now during this recent correction. The market had a great day today, a nice bounce back after the selling over the last couple of weeks. So I got 3 of my favorite stocks for you guys. Let's get into it. All right, guys, here's a look at one of my bigger accounts right now. We're back over 100K, up almost 13% today. I was buying and buying and buying during this recent correction, right? So over the last month, we're still down 12%. Last 3 months, we're down about 8 grand. 6 months, we're down about 2 grand. And over the last year, we're still up huge, up around 20 grand in this medium-sized account, right? So 25% over the last year. I'll take that any day of the week. All right, guys, the first stock that I'm adding to right now is Cloudflare. Cybersecurity is something we're all going to have to get very familiar with as we move into the future. It's going to get bigger and bigger and bigger and bigger, right? I love this company. It's a global network concentrating in Europe, Asia, and the United States, and spreading its wings in Australia, Africa, and South America, right? 35% of Fortune 500 companies are paying customers as of December 31st, 2024. Incredible, man. 13,000 networks, 335 cities. I mean, 27% year over year large customer growth, and that's what you want. You want to protect the big dogs, because with those big dog accounts comes those big dog dollars, right? 95% of the world's internet-connected population is within 50 ms of a Cloudflare data center. Huge, guys. All right, guys, this is their global cloud platform. They got 3 really tiers: Zero Trust, Network Services, and Application Services, right? This is all the things that they provide for customers all over the world, from smart routing, load balancing, secure web gateways, you name it, Cloudflare does it, right? And when you're looking at any company in a certain sector, you always want to compare it to what other companies in the same sector are doing, right? Revenue growth, top 3 are Sentinel, Cloudflare, and CrowdStrike. Revenue growth is around 25% for all these companies. And what I like about Cloudflare is they're not quite as big as Fortinet, CrowdStrike, or Palo Alto, so there's still room to grow. And grow means we can grow our bank account, right? The market cap coming around $49 billion is even less than when we made these graphs, right? Price to earnings ratio, right? Cloudflare is still not profitable. Their operating margin is still in the negative, but we're getting closer and closer to profitability, and that's what I really like when I'm looking for these types of investments. All right, guys, let's take a look at Cloudflare's valuation. Forward PE coming in pretty good. It's at 136 right now. This time last year, 163, and back in 2023 is 150. So we're getting a better value for our dollar right now. Price to sales is right around the best it's ever been, right? Minus in September when we had that correction and it was down in the 18s, but it's lower than it was a year ago. I like that as well. Everything is looking metric-wise pretty good for what we're paying for right now at around $116-ish per share. That's where it closed today. So now let's take a look at the broader picture of this company, right? I always like looking at the income statements, right? And revenue, top line, growing. And what we want to see is this bottom line getting closer and closer and closer to profitability. And that's really what we're seeing here, guys. Back in 2024 in March, they were losing 35 million, went to 15 million again, and down to under 13 million. But the top line continues to grow quarter over quarter from 362 all the way up to 459 million in 1 year. And if you look at these metrics, revenue's up, operating expenses are up a little bit, but it's always less than the revenue growth, which I like to see. Net income, 53%. Net profit margin up 63% year over year. EBITDA up 60% year over year. They're getting closer and closer to breaking even, and then the profits start to roll in. I absolutely love that. Okay, guys, here's take a look at the balance sheet, right? Total assets to liabilities. You know, the assets continue to grow from 2.76 billion up to 3.3 billion, right? And this recent quarter, we did have a jump up in liabilities. But sometimes you got to spend money to make money. And in this growth phase, that ramp up phase, that's kind of what happens. But the cash and short-term investments is up 11% year over year. Total assets is up 20%. And the liabilities are up 12%. But again, assets are growing more than liabilities, which I always like to see in these younger companies, right? Cash flow, it's all over the place, right? I'm not going to bullshit you guys. This is a higher risk investment because it's not a profitable company yet. But in your portfolio, there's always room for a few companies like this, right? And this is one that I'm buying, especially at this almost 40% discount where it was trading just a few months ago. So I like the risk to reward in this company. It's one of the better cybersecurity companies that still have room to grow, in my opinion. And there's plenty of space for all of these companies to eat because this is an industry that's going to continue to expand and expand and expand over the next 5, 10, 15, 20 years, in my opinion, right? So that's my first stock, NET. That is Cloudflare. All right, let's move on to stock number 2. All right, investors, the next stock might surprise you a little bit, but that's Target, right? I like Target's brand. I like their stores. I like the quality of their products way more than Walmart, right? So I've recently been traveling to some Targets in the Los Angeles area just to check out what's going on. And the stores are really, really busy. So I'm going to show you why my thesis is reiterated by the busy traffic that I'm seeing, right? So there's no way around it. Target has been getting destroyed, absolutely obliterated. For a stock like Target to be down almost 40% in the last year, it's crazy, man. They're getting destroyed. Down almost 24% just this year alone. It's only March. So, I mean, they're getting crushed. But these numbers are starting to look pretty freaking juicy, right? Especially this dividend over 4% right now. Most high yield savings accounts are under 4% right now. So if you get any share appreciation along with that dividend, you're going to make out really well with this stock. This PE ratio is under 12 right now. The S&P 500 trades in the 20 to 23 range depending on what day. All right, guys, one of the main reasons we're seeing this sell-off in Target stock is because they ended some DEI initiatives. And a lot of people have been boycotting the Target brand. But as an investor, I don't get really involved in politics. I just want to make money, straight up. However you feel about DEI, I don't care. But I care about making you guys money. That's why you got to subscribe to the channel. And I see opportunity here. Okay, so in this kind of cycle, sometimes your company is getting good press. That's going to pass. Sometimes your company is getting bad press. That's going to pass. But the business is the business, right? And if your business continues to grow and make money, that's what matters to me at the end of the day. So when I'm looking at Target stock, right, trading at $104 is absolutely bananas, right? At one point, you know, the stock was soaring in the 170s, man. I think there's some money to be made here. That PE ratio is looking really, really juicy for sure, guys. So I'm going to take a look at the financials and kind of figure out what the F is going on with Target, right? The gross profit, looking pretty damn good to me. Back in January of 2023, here's the number, 26 billion. Then here, gross profit, 30 billion. So the company is freaking growing, guys. And I love that. The revenue is about the same, but the bottom line continues to improve, right? Let's take a look at some of this stuff. EBITDA. If you take a look at these numbers back in January of 2023, the EBITDA was, what, 7 billion? It's 8.6 today. The numbers look pretty damn good to me, man. And we look at the statistics, right? Market cap, lowest it's been in for freaking ever. Straight up forever. The trailing PE at 11, forward PE at 11. The PEG ratio is right around where I want it to be. Great value at 1.44. Anything around 1 is great. Price to sales is under 1. Price to book at 3. Enterprise value to revenue under 1. I mean, this company, for me, is looking pretty solid, right? As a business, let's take a look quarter over quarter, right? So, obviously, at the beginning of the year is when all this kind of craziness started happening. But if you look quarter over quarter, from May, let's look. This is a really big number here. at 32 billion. So let's take a look at the last 4 quarters. 24 billion, 25 billion, 25.6 billion, up to 31 billion. So we're almost back to where we were at back in 2024, even though all this negative press is coming out about Target, right? So annually, you get to see that the numbers still look pretty good, and this company is still making the same amount of money that it did when this company was trading at $180 per share, $170 per share. So that's where I start to see some opportunity, right? If you look year over year, the numbers haven't really changed too much, right? Everything's pretty similar, but the total assets continue to grow year after year for Target, up to $57 billion. And if you look at the total assets, they're up 4%. Total liabilities up 2.8%, but the cash and short-term investments up 25%. I like that number, guys. I like that number. And in 2022 and 2023, they really struggled. But over the last year or two, they've been starting to turn it around. Cash from investing up 40%. Free cash flow. This is a great number. 52.95% in free cash flow. So that means they're getting rid of some liabilities and really going to be able to grow this brand as time goes on, in my opinion. That's why I'm a fan of buying Target right now, man. $177. It's at $104 right now, right? So, and it's a pretty stable company. Like, I can't see Target going out of business, but do you want to buy a falling knife? That's what you got to be careful about, and add slowly. Like, the trend is very negative right now, and we don't know how long that trend's going to last. It could last another year or so, but that's a great time to accumulate, because at some point, all this negative media is going to go somewhere else, and Target is going to look pretty cheap for investors, right? If you take a look at this company, forward PE in the 11s. I mean, the growth isn't huge right now, but the company still looks pretty damn good to me, man. I think it's a solid company. And I think with that dividend at 4%, so you're getting pretty good value there as well. I mean, for me, guys, I like it. I like Target. I think it's a good buy. Under $100 looks pretty damn good to me. Let me know in the comments, what are your guys' thoughts about Target stock, right? I think the enterprise value is so low right now for what we're getting in this brand. It makes a lot of sense, right? The enterprise value at $62 billion, that's what we're buying it at right now. And the market cap at $47 billion. And then over the last year or so, we're getting a 15 to 20% discount on the market cap valuation. I really like that. I think Target's a buy. At under $120, I think it's a buy. Under $100 is definitely a buy for me, because as the price goes down, the dividend percentage continues to go up. So selling cash secured puts on Target makes a lot of sense. Sell it at 95, 90. This way, the worst case scenario is you got to buy Target at $95 or $90, but in the meantime, you can get some premium along the way and buy Target shares. All right, let's go on to stock number 3. All right, investors, let's move on to the third stock that I'm buying and accumulating during this recent sell-off, and that's SoFi stock. If you follow this channel, you know I'm a big proponent of SoFi and the company. I love the CEO, Anthony Noto, and the stock was around $18 a share, and today it had a great day. But it's still trading in that $12 range, considerably off the high, right? Still down around 33%, and that's just since January 24th. It hasn't even been 2 months. So the stock has been getting slaughtered, and I think it's a great time to pick up some shares. Let's check out the valuation real quick. All right, the market cap trading right around $12.5 billion, right? Pretty cheap, not as cheap as it has been in the past when the stock was in that $7 or $8 range, but I still think it's a great value, especially when you look at the forward PE. That's pricing in the projected earnings down the road. Back in 2023, in December, it was at 181. The next quarter, 104. In June of this year, 75. Went down to 32 in September. Bounced back up to almost 80 in December. And now it's back down to 35. I think this is a great opportunity. PEG ratio under 2 for a company growing this much is a great value in my opinion. Now, let's take a look deeper into SoFi stock and take a look at this growth. Woo, baby. Look at this growth annually since 2020. Revenue $565 million up to $2.64 billion in 4 freaking years, guys. That is insane. Almost a 5x. Crazy. And then if you take a look, bottom line, they were losing $483 million in 2021. They were losing $483 million in 2021, losing $320 in 2022, losing $300 in 2023, and now we're making $500 million on the bottom line. The numbers look great. Revenue up 28% year over year. Net income up 265% year over year. Net profit margins 230%. Like, where is another company that's profitable growing this much? If you could find one in the market, I would love to know, because that's the type of company I want to invest in, and a company you should want to invest in too. To be perfectly transparent, I do own around 5,000 shares of SoFi stock, and I'm trying to accumulate up to 10,000 before this stock goes parabolic. Earnings per share up 282%. The balance sheet is looking pretty juicy as well, guys. I mean, just look at the total assets, man. Just since 2021, $9 billion to $19 billion to $30 billion to $36 billion. And then, I mean, obviously, as this company continues to grow, the liabilities grow with it, but assets are always outweighing the liabilities as they buy these other companies. Like, they bought Wyndham Capital, a mortgage company, so we have to take that into consideration when we're purchasing an asset, right? But the assets up 21% year over year. I love that. Cash flow dipped down a little bit in 2024, but we saw exponential growth between 2022 and 2023, right? So cash flow went down because we're starting to expand the business, guys. And when you expand the business, the cash flow goes down. But the net income up 265%. Cash from operations up 85%. I love that as well. And they're using some of their cash to grow this business model. And I just love SoFi stock. Anthony Noto is one of the best CEOs in the entire stock market. And the last month, guys, down 25%. I think it's a great value. Under $12 a share is definitely a buy. Probably even under 15 when you're looking at long term. But remember, the market has been extremely volatile. So I'm not telling you guys to buy a shit ton of these stocks right now. Buy chunks weekly. 25 shares of SoFi this week. 25 shares the next week. Enter slowly. So if there is something crazy that happens with a macro type of situation, then we could, not spend all of our money in one shot, and we can continue to accumulate as prices go down. These are good, solid companies that I think will be around for the long haul, so that's why I'm starting to invest in them. I hope you guys got something from this video. If you have any questions, let me know in the comments below, and don't forget to like and subscribe. Peace.